Home builder stocks are absolutely cratering, which is very interesting because there still seems to be a housing shortage in the US. So what's actually going on here? Well, this is one of those stories that's really being underreported in the current environment. So that's what we're going to dive into in this video. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome to the channel where the purpose here is to help 1,000 people achieve financial independence much sooner. That's why I give away the free courses and I give you guys these videos and I respond to every question in the comments. So hit me up. I will always respond to you guys no matter how big this channel gets. So let's get right into this home builder situation. So you can see here from this article that I found on Seeking Alpha, the housing market is booming, but home builder stocks are getting crushed. And so what exactly is the story here? And the story is that there's huge projected earnings growth and rock bottom valuations. And the author of that article notes exactly what I believe, that this is probably the most interesting story that's not really being covered in the business news media right now. Now, of course, if you guys have been watching this channel for over a year now, you guys would know that when this channel started last year, one of the first few companies that I was interested in were the home builders. I really like the spec builders, like LGI Homes, under $100 per share. And you guys can see from here that when I was buying into LGI Homes, it was under $100 per share, or just about $100 per share. And then it ran up to like that $150 per share area where I thought it was a little bit too pricey given the risks of a rising interest rate environment. And so I completely got rid of the stock. And then it was pretty interesting. The stock continued to increase after I sold it. I think I sold it around like 130 or something, but it just continued to go up. And then of course it cratered. And you can see it better from here, where you can see that the stock is down over 50% of its high of around that low 180 area to around $90 per share, which is where it's at today. And LGI Homes is not the only home builder that stock has been cratering. You can see here that DR Horton is down 25% since May of last year. And of course, you can see that, and that's on a low base, because you can see in January it was trading much higher than the $95 per share, which this 25% is being calculated on. It was trading as high as $110 per share. So it's come down a lot. With Lennar Corporation, it's the same story. It's come down a lot from its approximate $120 per share area to now down to $75 per share. And of course, since last May, it's down 29%. And then Toll Brothers, same situation. All of these guys really ran up in December, January-ish, and then they've just completely cratered downward. And here's the interesting thing. Because the supply of new homes is so short, the earnings estimates are still remaining high. And so you can see here that the consensus 2022 EPS remains strong for LGI, DR Horton, Lennar, and Toll Brothers. So you can see that all of these companies are trading at approximately 4.5 to just over 5 times earnings for 2022. And then the consensus 2023 EPS, now when I say consensus, these are the analysts, not me. My earnings are a little bit lower than what the analysts. I think that they're a little bit more aggressive than I am. But that being said, the consensus forward EPS for these companies in 2023 are around that 4 to 5 times EPS. So these companies appear to be very, very cheap. That being said, don't forget, guys, that home building does tend to be cyclical. And so is the question that the earnings are going to fall from under these securities. Now, with that said, I've been doing a lot of research on analysts that have been chatting about the real estate market. Here's an analyst by the name of Stephen Kim who's talking about what the consensus estimates mean for 2022 and why he believes that the consensus estimates might actually be lower than what he thinks that they're going to come in at. So here's that video.
Stephen, it's great to have you back. You're not more worried about rates here and the underperformance we've already seen?
Well, I certainly think that volatility is going to be the watchword for 2022. And certainly what we've done in our note is we've also recognized that, and we've actually taken down some of our target multiples. We think it's going to be a hard-fought year. We think it's going to be earnings-driven, any upside in the group. But on the other hand, we also see so much upside in the earnings relative to what the street is looking for now, that we think at the end of the day, these stocks have significant upside. I mean, many of the stocks, even with our reduced multiple targets, show 50% upside from here. And so that's just too much to pass up. We think it's going to be a tougher year, but we think it's going to be one that's ultimately going to have the builder stocks higher.
And of course, it probably comes of no surprise to anybody. You guys already know what's causing investors to be really hesitant on purchasing home builders. You can see here that the interest rate is absolutely surging and it's rippling through the economy, not just impacting home sales, but also car loans. You can see here that the average 30-year mortgage rate is nearing 5%, where it was around 2.75% in 2021. So you can see that it's really surged. So of course that's going to impact affordability. I have a really good chart here to show you how it's impacting affordability. So you can see early in 2020 that the price of homes were the only reason why homes were getting less affordable. But you can see that the huge declines in the interest rate and increases in income drove affordability higher. So more and more people were able to purchase homes. But then you can see what happened throughout the year. The price of homes started to surge, especially in the second half of 2020. So you can see that affordability started to decline because the price of homes really picked up. And now, closer to early 2022, you can see that the interest rates, as they've been increasing for mortgages, is causing affordability to decline. But what's interesting is notice how there's been a pullback in the affordability factor from the price of homes. That doesn't necessarily mean that the price of homes are declining, but I do personally believe that you are going to start seeing environments where the home prices do decline to make up for the fact that the interest rates for these mortgages are increasing. Because at the end of the day, I do believe that homeowners buy payments, they don't buy home prices. It really doesn't matter if the home price is $1 million for the house. If your monthly payments are $1,500, you're still probably going to buy that house. Obviously, you do set yourself up for a tough situation if rates do increase in the future, and now you got $1 million home that you got to pay a much higher mortgage rate on. But that seems to be the dynamic that drives the market. And of course, most Americans can lock in their rates for 20 or 30 years. So it doesn't really become an issue for them. So that was a really good chart, and it really visualized what caused homes to become more affordable versus now what's causing them to be less affordable. But here's another chart that I wanted to show you. And this is something that a lot of people aren't necessarily talking about. There's a lot of talk on platforms like YouTube where people are saying, yes, the interest rates are going to continue to go higher. And I do believe that they are going to go higher. But here's something that happened just a couple of years ago. The Fed's previous attempts to raise interest rates since the financial crisis haven't gone as smoothly as we expected them to. If you remember, in 2018, the Fed raised interest rates 4 times, and then the stock market fell by 6%, and then the Fed turned around and began cutting rates the next year. So you can see in 2020, right before the rates went to rock bottom, they actually were cutting them previous to that. And I don't know if you guys remember, because this might be before you guys got into the market, but when Janet Yellen was the head of the Federal Reserve, one of the things that she was saying is that she was raising rates so that they have maneuverability if they need to reduce rates if another economic situation came. Another economic situation did come, which was the pandemic, and so they completely reduced rates downwards again. So I think that might be some of that thinking as well, where they need a little bit of room to reduce rates if another economic situation occurs. But also they're trying to fight this inflationary situation that we have in the market right now. But I would say just off the cusp, there are some natural headwinds to the inflationary story, which is the fact that more and more people are retiring. And we already know that spending follows a life cycle. So as people retire, they generally hold on to their money and they spend less. So there is a deflationary sort of thesis built into this market, which will help the inflationary story. Do I believe that interest rates should increase? Yes, I do. Let's just be measured in our response here that there are things that are working against the inflationary story. And of course, you can see here that these higher rates are impacting auto loans. The average 4-year auto loan for used cars is now getting close to 5%. And the average 5-year new car auto loan is getting close to 4.25%. And of course, you guys know those supply chain issues have caused new car prices to surge, which have also effectively caused used car prices to surge. And so affordability is still a factor just based on prices as well for cars. And so I think a lot of people have been holding off on car purchases. So you might actually have pent-up demand here as well. But as a contra to my pent-up demand theory, you can see here that it was reported just yesterday that demand for used cars has dropped from a year ago, but high prices aren't budging. So it looks like consumers don't like the prices, but I think people are still buying cars based on necessity, which is that whole pent-up demand situation that I'm discussing here. And that's the reason why prices haven't declined yet. I do believe that car prices will come back into this stratosphere though. And of course, here's where the rubber hits the road. Higher affordability is going to take out the number one customer that we were hoping would continue to purchase homes, which is the new home buyer. You can see that first-time home buyers are simply just walking away. Homes have become so unaffordable that they've sort of been backed into a corner here. And you can see here, this is a great chart which shows exactly what's happening. A lot of people are just locked out of the home market now as homes are just less affordable because prices and interest rate increases. Just for an example, look at New York. The cost of a home has increased from, in 2019, from around 7 times earnings of a median household income to closer to 8 times earnings of a median household income. So that's 2 turns. And then, of course, higher price areas like Los Angeles only got higher. And then, of course, the areas that you're seeing have huge surges like Austin, Tampa, Nashville, Miami. All of those prices in those areas have been surging. Of course, Austin's been a big hub because a lot of people have been moving into Texas. So you can see that they've really pushed up the prices in Austin to the point where it's becoming less affordable now. So there's really nowhere to hide from the double whammy of the surge in home prices and now the increase in interest rates. And all of this doesn't bode well for home builders. The only thing that I would think that's sort of helping their thesis is that I really think that the purchase of new homes is really necessity driven and not any sort of like greed driven right now, which is the reason why home supply is so low. In certain areas like Tampa, you're looking at like 1 or 2 months home supply, and that's it. And so a Zillow survey went on to say that the lack of supply is not going to last forever, but it could be 2 years at least until the share of first-time buyers rebounds to pre-pandemic levels. Meanwhile, buyers can expect a combination of a short supply and heavy competition based on that needs-based buying, which I was describing earlier, which will keep home prices climbing while mortgage rates remain well off their pandemic lows as the Fed continues to increase rates to tame surging inflation. So this article is going on to say that the home prices aren't actually going to decline. I personally believe that home prices can decline. I'm starting to see it in certain areas. I've been actually physically tracking sort of the major markets that people are going into, which is like the Dallas markets, the Florida markets, the Pittsburgh markets, which is underreported. People aren't really talking about that one, but that one has been a surge for first-time home buyers. Also, the greater Detroit area markets as well. So I've sort of been following all of these areas. And what I am noticing is that the homes outside of the city centers are starting to decline. So it hasn't really made its way into the media just yet, but I think that that's coming. I got these Zillow screens that I run every day and I've been watching it, and that's kind of what I'm seeing. So what that tells me is that affordability could potentially get better. And of course, you can see here from this article that was published at the end of March, mortgage rates are continuing to increase and housing stocks are getting crushed. And what this article author is saying is that don't expect these companies' share prices to find a floor until rates find a ceiling. So essentially what he's saying is that these stocks could potentially be a falling knife. And you guys already know, never purchase a falling knife while it's falling because it's going to continue to bottom out. That being said, I am going to talk through a way that I'm sort of thinking about this with respect to downside protection in this environment. And so what I want to share with you guys next is my valuations for these home builders, because I'm actually seeing a lot of upside to these names in this environment. And as you guys can see here, this is stuff that I've already shared with the Patreons. They get full access to this at the $5 a month tier. So if you want complete access to these models, I would encourage you to join us. And like I always say, if you join the Patreon and you poke around and it's not for you, just send me a message on Patreon and say, hey, Tay, I tried it out. It's not really for me. And I'll completely refund your Patreon subscription in that first month. Now, that being said, you can see here with DR Horton with a terminal multiple of just 10 times earnings, I'm valuing DR Horton at $116 per share. And with its current share price of $71, you can see that it's trading at 61% of its valuation. Now, I'm not a big buyer of DR Hortons, and the reason why is because I don't actually like the tracked builders. I think there's an inherent level of risk of just holding a lot of inventory. I understand that in this market, there's probably not a lot of risk with inventory risk. That being said, I still like the spec builders that can maneuver around pretty quickly. And so that's why I like the LGI Homes more than I like the DR Hortons or Lennars. But just from a completeness perspective, I like to give the Patreons a valuation for all of them. Now with Lennar Corporation, you can see that just at a terminal multiple of 10 times earnings, the EPS valuation is $136 per share, with the current share price trading at around $75 per share, or the share price as a percentage of valuation of around 55. Now there's two catalysts for Lennar that a lot of people aren't talking about. The one is that Lennar is looking to spin off all of their non-home building assets. And I believe that that could get them around 1/5 of the current share price. So there is some excess capital here. And that's something that I'm going to look more into. The second thing is, with the Lennar, there's Class B shares. I want to look into exactly what sort of income that the Class B shares are entitled to. I believe that it's the same amount of income as the Class A shares, but they generally trade at a lower amount. So if you can get the Class B shares and they're entitled to the same excess capital as the Class A shares are when Lennar spits off the non-home building assets, I think you have a real value opportunity here. But that's something that I'll make a video on later once I do the research. And of course, my favorite, LGI Homes, you can see that at a terminal multiple of just 10 times earnings, they have a valuation of approximately $190 per share. So the valuation really hasn't changed from the first time that I was valuing this company. That being said, the current share price of $90 reflects a price to intrinsic value of 47% or 48% if you round up. And what that really reflects is, if you can see here, in fiscal 2022, they're expected to earn $17 per share, and a lot of those sales have already been made. So this company is trading at a multiple of 5 times earnings based on the current share price, which is absolutely nuts in my opinion. But here's where I can get a little bit greedy. I understand that you could have the earnings taken away from you. I don't believe that the earnings will get taken away from you, but there is an opportunity here where, yes, it's trading at 5 times earnings, but what happens if the earnings get cut in half? Now you have a stock that's really trading at 10 times earnings. So it's not really a significant value here. I get that argument. And so that's why I'm always looking at downside risk in this environment, especially with cyclical names like Homebuilders, right? And so if you look here, you can see that the cash secured puts for the December 16th, 2022 options contract at $75 is yielding between $6.30 per share and $8.50 per share. So what exactly does that reflect? Well, you can see here, I'm doing the math for you now. Just an FYI, guys, I do this math for multiple securities every month on our monthly Patreon call. I walk everyone through sort of the cash secured put opportunities and also the covered call opportunities. But like I always say, the best way to make the most money is just buy shares straight out. Don't worry about the options opportunities. But that being said, I really like using options to reduce risk in my portfolio. And so it is something that I do talk about. A lot of the Patreons that are on the monthly calls do believe that that sort of pays for itself. And so if it's something that you're interested in, please join us. We have 2 calls every month. Now, going back to this, you can see that the $6.30 reflects a 12.2% annualized yield, and it gives you a net $68.7 per share purchase price, which reflects 4 times next year's earnings. So a PE of 4 times earnings. Now, what I'm really looking to get is closer to that $8.50 cash secured put, because you have an annualized yield of 15.4% plus a $66.5 net stock purchase price, which reflects 3.9 times earnings, or a PE of 3.9 times. And that's kind of crazy, because if you're now buying some of these wonderful home builders at less than 4 times earnings using cash secured puts, you have something going for you. Even if the earnings get cut in half, which could happen, you still end up owning a company at 8 times earnings. So very, very interesting stuff here. And just to put this into perspective, if everything were to just go steady as she goes, the next 5 years of discounted EPS amounts to $78 per share. So yes, the earnings could fall and you could make less than $78 per share over the next 5 years. That absolutely can happen. But what I'm trying to get across here is that if you end up buying this for around $68 per share, it's so low that a lot of that downside has already been baked in. And that's kind of how I'm thinking about this right now. And so I am looking to add more to it. I think LGI Homes is around 3% of my portfolio right now, and I might get it to around 6%. We'll see what cash secured puts I'm able to sell. That being said, this market has just been really exciting for me. I've been buying more shares than I've purchased in the last couple of years, and so I'm just going to be continuing to deploy capital into this market. And overall, what is the thesis here for me? And you guys already know that America is short more than 5 million homes, and home builders can't make up that difference. And so you can see in a lot of markets that they're down to 1 or 2 months worth of home inventory, which is absolutely nuts. And so single family home construction is running at the slowest pace since 1995. And part of the reason for that is the supply chain disruptions. I truly believe that home builders, if they could build more homes, they would be. So what's really happening here is that the EPS consensus estimates for 2022 just reflect the constrained amount of homes that the home builders can build, not what they could potentially build if the supply chain constraints were to go away. Now, a lot of people who don't like home builders are going to say, hey, look, you're buying the dip here, but it's going to continue to go down lower. And I fully acknowledge the risk of this being a cyclical environment. And so what I always love to do is I always love to play devil's advocate here. And I try to find people who disagree with me, because at the end of the day, when you buy a stock, essentially what you're doing is you're playing a game of arbitrage. You're saying that I'm willing to give you my money for a stock because I think it's worth more than what it's currently trading at. So effectively what you're saying is that you are smarter than the collective intelligence of the stock market community. And I never like to think that I'm smarter than the stock market community. So all I can do is say, this is what I think it is, but I could be wrong. And so that's why I always like to play devil's advocate. So I actually found an article where a guy concludes that home builders are not to be purchased right now. And you can see here that Logan Kane on Seeking Alpha, where he's saying that the housing market is booming and home builders stocks are getting crushed. And essentially what he concludes with, I want to start with his conclusion just to let you know where he's going, is that the population of the United States hasn't changed much since the start of the pandemic, but housing demand has surged. And so the key question here is it cyclical or is it secular? And I always acknowledge that home builders are a cyclical business. There will be a point where there will be too much homes built like we saw in 2008. And so he concludes that given the demographic picture, he believes that the preponderance of evidence suggests that the housing market boom is cyclical and will result in a bust. Therefore, home builder stock appear to be a value trap. Now, I totally respect his opinion. I just respectfully disagree that this is a value trap. And here's why. I'm going to go into more of his discussion. So he goes on to say, if 30-year mortgages were to go to that 5.5% range, which is kind of where it's going right now, and home prices don't fall, the affordability of homes relative to incomes will be the same as it was in the 2006 and 2007 area, where such conditions were sufficient to cause a massive housing crash. I absolutely agree with you. But it wasn't just those conditions that caused the housing crash. If we recall, one of the reasons why we had such a big housing crash is because we had adjustable rate mortgages in that time frame. And we had a bunch of subprime mortgages and liar loans. So to suggest that the two environments are comparable is disingenuous at best, because now the majority of buyers have 20% down into their homes, whereas before that wasn't the case. The disclosure requirements to purchase homes in the 2006 and 2007 environment were absolutely not the same as they are today. There is a much more risk-based underwriting process that we have today than we had back in 2006, 2007. So I respectfully disagree with his conclusion there. And moving on, he says that a classic way of looking at the housing market is to compare household formation with housing starts. I agree there. You have to make some adjustments because around 300,000 houses are knocked down each year. But let's just say that there's 1.4 million homes built each year. The 1.4 million homes built is a big number compared with the population growth that is expected to be around 0. And so here's where we disagree once again. Yes, I do believe that the population growth is stalling, but I do also believe that immigration is going to continue to cause the U.S. population to continue to increase. That being said, the one area that he's neglecting to mention here is that if there is a demand for 1.4 million homes every year, that's not how many homes have been getting built for the last 5 years. We're actually behind significantly on that. So you really have to look at that number in conjunction with the number of homes that have been being built. And you can see that there's a severe shortage of homes just with the level of months inventory, which has been significantly declining. And of course, he concludes here with saying that the grand experiment with emergency era socialism could be distorting market signals, leading companies to make huge investments based on long-term demand that's in fact a mirage. Millions of people are not capable of paying their current level of housing without governments paying for them or blocking the legal system from evicting them. So effectively, he's concluding here that you need a perpetual amount of government aid to keep people in their homes. And I just personally disagree with that conclusion. I think that people can stay in their homes without government assistance. Now, with that being said, I'm not suggesting that there can't be pain in this market. In fact, I expect pain in this market. Once again, I go back to this slide where I say that I'm seeing an opportunity to buy a really well-run spec builder at under 4 times earnings if you can sell that cash secured put. But with that said, I will never encourage you guys to buy or sell securities on this channel. I just provide research. I highly encourage you to reach out to your investment advisor to see if putting home builders in your portfolio is right for you. This is just something that I've been looking at, and it's getting more and more enticing to do. Now, although I believe that the lack of supply is the bull case for continuing to invest in home builders, I found it very interesting what the Evercore analyst thought, and here were his thoughts on the market.
But you say basically the lack of supply is the key reason why the market will continue to outperform. At what point do the stocks acknowledge that?
Well, it's been happening gradually. It's certainly something that I think continues to surprise people. Like for the 18 months now, we've really heard people, raise one concern after the other as to why housing's not going to do well. At this point, I believe most people believe that it's a very bad time to buy a house. I think that is by far and away consensus. And what I would tell you is that when no one thinks it's a good time to buy a house, you don't have a housing bubble, right? And so what's going to happen is that you're going to have this group climb the wall of worry. Home prices are not going to roll over. They're going to actually continue to move up because of this crushing lack of supply. And I would also tell you that, you mentioned rates, and that's certainly very important. And rising rates is obviously not good for housing. But I would say from the fundamental side, remember that home buying right now is need-based. The demand for housing is motivated by need, not greed. We have underbuilt this country for 15 years. Nobody wants to buy a house if they don't have to. Speculation in the market is still very contained. So if market demand is driven by need and not greed, it's going to be much more resilient to rising rates than it might otherwise be.
And so as we move into the 2022 market, some of the things that I'm really thinking about are how are supply chain issues going to continue to impact home builders? And how is affordability going to impact these home builders? And so in this interview, the interviewer actually asked the analyst these questions, and here were his responses.
So, Stephen, what is the bigger thorn in the side of home builders? Is it rising rates or is it supply chain problems? What's vexing them more?
Certainly, I think that we went through a period, Tyler, over the last 3 months where supply chain dysfunction was an issue that investors had to grapple with. And I think it made earnings move sideways for a quarter after after quarter of moving higher. They kind of moved the margins moved sideways. Mm-hmm. We think that's going to resume here because the builders have done a very good job of adjusting to this new reality. Look, home building is a complicated business in the sense that there's a lot of parts coming from all over the place. They got to come in a certain order and all that. And so it certainly was an industry that was impacted, saw lengthening construction times. We think that those construction cycle times will certainly not lengthen materially in 2022. And you know what? If they actually start contracting, then you're going to get builders that are going to be able to surprise people with how many sales they can make, because right now they're not selling more because they can't build more. If they can build more, they're going to sell a lot more.
So I continue to see a lot of opportunity here. But here's the thing. The problem with being a value investor, sort of like a contrarian type investor, is that every time you see an opportunity, you're always going to be unpopular with that opinion. I remember back in March of 2020 when I was unloading my whole life savings into the market, everyone around me was saying this is not the time. The market's going to continue to fall further. But I just followed my personal valuations of the individual securities that I was following, and I didn't care which direction the market was going. In fact, I expected the market to continue to decline further, but the valuations were such that I purchased anyways. And then, of course, we saw what happened subsequent to March 2020. That being said, I'm seeing another opportunity here with restaurant companies. And you can actually see the video that I made on 2 restaurant operators right here.